Let's talk about the importance and utility of a stop order. Now, I have got a chart of Boston Scientific here that we've used in other examples here from the stock report this week. And now we're showing today's price action. When I recorded this video, it's a Monday, and we have another signal buy candle. We don't have an upward confirmation candle yet, but we have a signal buy candle. And I could take that down intraday like we've been talking about with intraday confirmation. And really what I want to see on this chart is I'd like to see it break this little resistance consolidation intraday. And so, that would give it a higher low and it would be a breakout and confirm. And I want to be able to buy up here if it confirms. And if I use a market order, I'll just get filled right away. So I won't get that confirmation I need. And if I use a limit order and I specify the price I want, well, the problem is the price is already below the trigger price I want to use. And so they have what's called a stop order. Now, a stop order technically isn't an actual order. The only two actual order types are market and limit orders. And you'll notice here that I have the choice of a stop or a stop limit. So if I click on a stop order, it gives me the price trigger. And this is the opposite of the limit order. What it does is it allows me to say, hey, I only want to buy at the specified price or higher. And if it triggers above this price, giving me directional confirmation, it will send in a market order. So if I used a buy stop market, I could put in the order and say, okay, well, I don't want to buy until it gets above 42.75. So I'll go into that, put that in at 42.75. And when I put that in there, I can, because it's a stop market order, I can make that good till canceled, I believe, and we can confirm and send that in. And when we go look at the chart, that is a pending order that will only trigger if the stop price gets hit. If it trades at or above that price, again, we've got it specified. Again, when you look at it, you can actually point to the ticket and it'll pop up at 42.75 or higher. It will trigger and send the market order in. But that can create a problem for a trader. Let me get back to the daily chart. Well, what if tomorrow the candlestick gaps up here and I get filled up here near, say, 43.50? And I get filled at a price that I didn't like, I didn't plan on, and if I had a stop loss down here, that would increase my risk profile. So if I want to buy when I get the confirmation, but I don't want to spend too much in case the stock price gaps or moves quickly, I can use a stop limit order. So I can go cancel and replace that order, and I can change it from a stop market to a stop limit, and when I do that, I get to put in two prices, the stop price, and then I can say, well, buy if it goes above 42.75, and then I can say, well, don't spend more than, say, 42.85, and that would give it a little 10-cent window in order to get filled. Now, this stock has an 80-cent ATR, an average true range, and so I want to give that at least 8 cents or 10% of the ATR window to help me get filled with that confirmation. So when I go and I confirm and send that order in, you'll still see the stop order sitting up there, and it still has the same stop price, the same trigger price, 42.75. But when this order triggers, it's going to send in a limit so that it won't spend more than 42.85. And if the stock were to gap up here to 43.50, for example, and of course it's moving the right direction, but we didn't get the price we wanted, it would not get filled after that stop has been triggered unless the price came back down below the limit order. Then it could get filled. But if it gapped up and ran, that trade wouldn't get filled because we used a limit order with the stop trigger. So remember, stop orders means trigger. And we can place that stop order and trigger into the trade when we get the right confirmation. I could also, of course, use a stop loss order and put in a sell stop market, or sell stop limit. Typically for stop losses, we use stop markets only, so we guaranteed to get out. And then that way, if the price went up and got filled, it then turned around and came back down, it would hit that stop order, and I can set up what's called a first triggers OCO. So I'm going to cancel that order, and I'm going to go recreate this with both a buy and a sell stop. So I'm going to go in and say, okay, well, I'll buy this, and I'll use the stop limit, and I'll trigger in if it goes above 42.75, just like we did before, and I'll say, but don't spend more than 42.85, and then I can make that first order trigger a sequential stop loss, and I can create an opposite order here, and I can change that one to a stop, plain old stop, and I can say, well, hey, if it dips below the support zone, I'm out. So I could come down and say, well, if it dips below 42.20, I'm out. So I bring that ticket back up and I say, hey, I'll set that trigger down here at 42.20. If it goes at or below 42.20, we need to get out of that trade. I could probably say, hey, let's give that a little wiggle room. Let's give it 42 even, so I can stay consistent with the recommendations on the scouting report. And I'm going to go ahead and make both of those orders good till canceled and link them together. So now, if it goes up, it'll trigger the buy stop and send in a limit order. So that's a buy stop limit. And then if that order gets filled, it'll put this trade in with the stop market so that if it dipped below 42, it would send in a sell market order and get us out. You now have a much better understanding of how a stop order works. Remember, a stop is not technically an order. It is a trigger. It's a price trigger. And for buyers, it specifies a confirmation trigger. Buy if the stock price trades at or above the specified price. Then it'll send in either the market or the limit as you specify that on the ticket. If you put in a sell stop order, if it goes at or below the stop price, it will trigger the sell, meaning it gives a selling confirmation. And it would send in either the stop market order, would send in the market order, or when the stop was hit, it would send in a limit order. And again, we typically use stop limits to get into trades, and we will use stop markets for our stop losses to help us get out of trades. Now I'm going to send that in, take a look at that, and now I have a trade with a trigger if it goes up and a stop loss in case we're wrong and it goes down, limiting our risk.